It's basically Buffett. I think you'll see the parallels. Hashtag Gucci, hashtag Ralph Lauren, hashtag positive vibes, hashtag networking, hashtag trader, hashtag lifestyle. I mean, right?
Buffett.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Doogles, when's the last time you heard an announcement and you were like, oh, that really created some strong public service?
Mid 1990s, there was a certain African-American gentleman that was on trial.
With the is this OJ? Is that where we're going?
Whoa! Spoiler alert! Spoiler alert!
And what was the PSA?
Not guilty was the PSA, and did a public service. Put that gentleman back on the street so he could do good, and everyone lived happily ever after.
Yeah, it's something like that. Something like that.
Okay.
All right. So the way I have a PSA about PSAs, but no, I really just have a PSA.
Okay.
People, if you want to live your life in a healthy, effective, happy way, you don't have to talk about everything. You don't have to have an opinion about everything. And the nonsense, you probably should just not talk about. And the reason I'm bringing that up is on today's show, we are not talking about GameStop. We are not talking about AMC. All this nonsense that's happened this week is complete and utter opposite of investing. We're not covering it. We are giving the cold shoulder, like the Drake meme, to that nonsense. PSA.
All right. So here's the bad news for you. So you know how 3 years ago,
it
was like 3.5 years ago, and I was looking at what I wanted to buy. We were getting into the fourth quarter of 2020, and a lot of stuff was still kind of down. And I said, movie theaters. So I investigated the movie theater chains, looked at Cinemark versus AMC. AMC's balance sheet was just a ball of flame. And so I bought Cinemark. Did okay on Cinemark. But then I felt so left out when AMC took off. So left out. So this week, AMC starts taking off. And I said, not this time. Not this time. So I took a loan out on the house. I won't even finish this.
I had closing documents done within 15 minutes. And guess what? I no longer have a house.
Yeah, the bad news is Wednesday was the worst day to start buying call options on GameStop. That's the bad news. No, I'm joking. We're not talking about a lot today.
All right, let's go listener mail. Let's hop in. Hit
the jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
You know what gets me most about this? I'm gonna tell you what gets me most, and then we'll back up and actually talk about what it is. What gets me most is we were just down in the Braskies, right, in Omaha for the Berkshire event. And one of my takeaways, I was like, it's so powerful that someone's, when you put Munger back into it, someone's were able to get a group of people that may not have been investors before into investing and got to make the money. I was like, this is powerful. If you could figure out how to do this in other ways, it'd be really powerful.
Lots of people figure out how to do it. Lots of people.
All right. Give the background on this.
Have much bigger parties too. And they probably have the Vegas atmosphere that we thought we might be walking into with Omaha. I can't give too much background because this stuff infuriates me. It makes me so mad. And of course, like there's never a quick way to be rich. And so many people are pitching it. So Bloomberg has a really nice write-up of I Am Academy, which promises a Wall Street education and unsurprisingly happens to be a multi-level marketing scheme, which is basically a Ponzi scheme that charges you a one-time fee of $275 and then $250 a month for trading strategies. They use that. I'm just going to call it a Ponzi scheme because I think that's what it most closely is.
Whoa. Okay. Multi-level marketing.
Okay. Multi-level marketing. They use that scheme. And for those who aren't familiar, basically, if I sell one subscription to the service, to my brother, and my brother sells it to someone else, I get a piece of all that action beneath me. So the people at the top of this pyramid do really well. The people at the top of the pyramid then make really good money, not because of the trading strategies that are sold. And then in today's world, they use the Instagram famous lifestyle to flaunt that money to recruit more people. And we all know how this ends.
Yes.
I'll let you
yes.
give like the solid background, but I read stuff like this and my emotions are strong because it's so sad the amount of people's lives that take a step back because they get lied to. And that's exactly what happens here.
I'll give a quick version of the background because it is worth understanding how these things come about. There's this gentleman who was a construction worker in the Bronx, Christopher Terry. He's just minding his own business, putting mortar between bricks. That's what he's doing. And he's like, how do I make Mo money? Fast forward a little bit. He ends up working for a woman. Her name's Linda. He ends up working for her, and she was a trader. Allegedly, according to this, she was, at least the way it started, a successful trader. And he was helping her out with selling subscriptions to her trading business. Like, how does she do what she does to win? So he was helping out with that. That's how he kind of jumped into the finance world. Linda ends up going belly up. So maybe it wasn't so successful. Ends up going belly up in 2014, about a decade ago.
You missed a point. Terry discovered Amway Corporation, a wellness giant famous for a multi-level marketing scheme.
Yes.
But go ahead.
So Linda goes belly up 2014, a decade ago. He says, I'm going to get into my own business. Thank you for that, Skippy. That's right. He had discovered Amway, which is also a multi-level marketing situation, and said, if I combine what I was doing with Linda with this multi-level marketing situation, chef's kiss, Salt Bay, beauty. He starts up that organization called at the time International Markets Live Incorporated. So IML. You'll see the innovation that comes in a moment.
Huge innovation. Huge.
IML. And so he starts this, and actually he doesn't get a lot of traction to start off with. People aren't really picking up on it. And he's like, oh, is it the strategies? You know what? Maybe it's me. Maybe I don't have the skill to do it. So he then hires a bunch of muscle-bound gentlemen, salespeople, who hit the road flexy on the social medias.
These are like your classic TikTok finance crowd, just saying everything is, I made $1 million overnight and I'm on my yacht, even though my yacht's rented and I can still see the rental paperwork on the
not
dashboard.
Even though I just smuggled myself upon someone else's yacht, took some photos, and then jumped off the side. Yeah, pictures in Greece, pictures in Italy. Look at me, cha-ching. And then it starts to pick up to the tune. I don't have the subscriber numbers in front of me, but the tune, it was like 50,000 people signed up. Then a couple years later, 200,000 people were signed up. A couple years, now we're millions, right? And so it starts to take off. And these are people that were not finance people. It's like TikTok investors. They were just people that they had the muscles and the charisma. That was it. They didn't know about the finance.
I mean, these are people that like pyramid schemes.
Oh boy, do they.
Like,
boy, do they.
Come on.
They do so well. They do so well with this. So it starts to take off. What we were joking about at the beginning, started throwing all these international conferences all over the world for people to come. It was Vegas party everywhere. And people started getting, and I guess still are, started getting so enthralled with this. It's the get rich quick. Wow, you're doing it. I can do it too. I want to give you the story of Monique Jones right quick. I'm just going to touch on a couple points. Monique Jones is one of the people that they give a little vignette in the piece about. She got caught up in this. And what they were telling her was, because it wasn't working. She came in and it wasn't working. And she was like, what am I doing wrong? Like, I'm doing what you're doing. You're in Greece and I'm in the gutter. What is going on here? And they kept telling her, you're doing it wrong. It's not about the strategy. You're doing it wrong. And then,
by the way, keep paying the $250 a month. That's really critical for us.
Yep.
Yeah.
And not only that, keep paying the $250 and make sure you go sign other people up so that you can cover these trading losses that you're having. And she described it as an abusive relationship. She said, I kept being told that I was doing something wrong while I kept feeling the pain. This is the line I shouldn't say the because there are many, a line that really gets me. And I quote from the piece. They said she needed to forget about her family, who were quote unquote losers, and surround herself with millionaires, meaning other IM members. Oh, I skipped the innovation. Sorry. At some point, I think it was the FTC came after IML and said, you got to shut this down because this is obviously wrong.
because it's
And
fraud. Yeah.
exactly. And the innovation was, oh, you're right. IML was a fraud. What about IM Academy? And then it continued on. That was the big innovation. So, but this is the kind of thing that happens. They say you're wrong. Other people might be telling you to get out. Look at them. They're losers. They're not like us up in Greece. Why would you listen to them?
Yeah.
Listen to the Grecians.
Ditch your loser family. You can be a scum-sucking leech like me and steal money from millions of people, and then you can take photos on Instagram. Christopher Terry, let me just, it's basically Buffett. I think you'll see the parallels. Hashtag Gucci, hashtag Ralph Lauren, hashtag positive vibes, hashtag networking, hashtag trader, hashtag lifestyle. I mean, right?
Buffett.
What is he selling? Great long-term investments, right?
Mm-hmm.
It's such garbage. This guy wasn't super charismatic, so he started studying mega church leaders so he could gospelize his rhetoric. I mean, it's so bad, Doogles. It drives me crazy. This is not investing. The fact that this gets lumped in with investing is frustrating to me. I'm going to take a quick aside. I hope it's okay. Dave Portnoy of Barstool Sports.
Oh yeah.
You know this character, right?
Oh yeah.
Has a famous video this week ranting about how the stock market is rigged and blah, blah, blah. Well, when Dave jumps into the stock market, he usually tries to day trade, which we know is a loser's game for about 99% of people. And I loved all the replies because the people that really know about investing posted long-term charts of the S&P 500 going up 50x and said, really? Like this is gambling? This is a rigged casino? No, you're doing it wrong. It gets me so frustrated that people like Christopher Terry get lumped in somehow to, what you and I do with a long-term focus that can absolutely be a winner's game and probably the best way to create wealth in this world.
Yes. Don't follow this stuff. Don't follow this stuff. You want to give a figure or two about how this has turned out in the aggregate?
So now they're in lawsuit land. So according to their own internal disclosure, more than 94% of people made less per year than they spend on subscriptions, lose money. And the only people that really make money are the top 0.05%. This is simply, you flip enough coins, you get a few extreme winners. Like there is absolutely no skill in the nonsense there.
Oh, speaking of skill, can I hop back to Monique for a second? I forgot about this point. When they told her that she was doing the trading strategy wrong, it wasn't that they said, according to this piece, it wasn't that they said that she was not understanding the philosophy or the strategy itself. They told her that she was copy and pasting the trades too slowly. So that's the skill that they're trying to say exists here. You know something's wrong when it's the timing of your copy paste is what matters. Like, can you, going back to your comparison to Buffett with all the hashtags, can you imagine if he showed up in Omaha one year and said, you know what, actually, it was a mistake to get into airlines because I spent 30 seconds too long copy pasting UAL into my Schwab account?
By day trading, it would, they also, I think it's Monique, but it could be someone else in the article, detail how they're afraid to go to certain family events and other activities because they are so involved in their day trade, right? Like they can't take a moment away.
No meals, skipping meals because it's too important. Yeah, this is, something's wrong.
It's incredibly sad. Makes me want to vomit.
Oh,
I hope they're prosecuted to the fullest extent of the law.
And do you think that's what's going to happen?
No.
Or is Fire Festival 3 also going to contain some of this nonsense?
All right. Well, we really appreciate the listener mail. Thank you for sending it in. I have a surprise listener mail. This one's actually from a random listener. I don't know where this came from. It might rhyme with Skippy.
Blippy?
And yeah, it was for Blippy. Yeah. Yep. And he just wanted to briefly check in on Doogles since the idea that won second place at the Berkshire annual meeting pitch competition was a short of Pool Corporation. Doogles, how you doing over there?
If you want to bet against me, bring it.
I love that, man. Yes, I love it.
Bring
And
it.
for those who don't know, this is 2-3 years back on the show. Douglas has liked himself some Pool Corporation. Now, Pool Corporation went public in 1995 for 92 cents and currently trades around $400 a share. It's been a great stock. This pitch effectively said that there's way more competition, and there's a competitor that is basically opening stores next door, which is a bold strategy. No, Douglas, I wanted to tease you about this a little bit, but also I love that answer, right? A lot of my stuff has heavy short interest. It's beat down because there's competition. That's not necessarily the case with Pool, but if you build a great company, what happens is competitors flood the space because you built a great company and there's margin to be had, right?
That's right. That's right. Bring it. I see you in the back at 3 p.m. in the alley. Okay, was that too far? Maybe I took it too far.
No, that's great. I love it.
No, but bring it. It's a great company. Well, only time will tell if the stock continues to rise, but I'm happy with the return I've had so far. I'm good with it.
Are you still holding? Let me just be clear.
Yes. Now, I will be in full transparency. I am still holding. Pool Corporation is 0.2% of my portfolio. It's not a material part of the portfolio.
Is this like a sentimental pick at this point?
Yeah, it's basically sentimental. Yeah. I do enjoy it. This was at some point it was a model stock that was told to sell. I decided to keep some of it in my portfolio because I have enjoyed the company for a while. This is a company that I've been following for over 20 years. I haven't owned it for that long, but
I'm interrupting here intentionally. Trust the model, Douglas.
Yeah,
you should have sold.
I know. I probably should. Some of it. I sold some of it.
Love it. If it's okay, I want to reach into my fishbowl.
Okay.
And talk about the happenings of the week. So, if you want a deep breakdown on AI and all things related to Silicon Valley, I would strongly recommend the BG2 podcast. Absolutely great. They have entire research teams behind them. It's Bill Gurley and Brad Gessler. Am I saying that right? They're going to cover AI way better than I am. But there were some big AI releases this week, and I spent a lot of time on ChatGPT 4.0.
Omni.
What's the official code name of this? Omni? Okay. And have the desktop app and have lots of thoughts for you, Doogles. But before we get into the serious stuff, please tell me that you saw the weird singer DJ dude at the beginning of Google I.O.
Oh, no, I did not.
So on this show, we love Silicon Valley, the sitcom, and Google has fully turned into Hooli, fully in every way, shape, and form. Do yourself a favor. Maybe we'll put it in the show notes. You got to watch the craziness that happened. Like some dude's just chanting into a mic about how Google is great or something. It is full on Hooli. It's really, really bad.
I just pulled it up, and so I will watch it right when we're done because it's up. Perfect. It's tabulized.
Perfect. So I had a really busy week, but I also made a new hire this week, and you know how you make time for a new hire. Turned out my new hire was a $20 a month large language model from ChatGPT. The reason I made time in my schedule for this is I used to do a fair amount of hiring of 25-year-old master's students. And I watched a demo early this week where someone dropped a data set into ChatGPT, asked it to analyze and visualize the data. And the result was better than the first couple months on the job of someone fairly green coming out of school, even with a master's degree. So I was like, I have to look into this. It's also relevant to my work. I did a bunch of things this week, Dougal. So I threw 10Ks at ChatGPT. I threw combination of 10Ks, podcasts, blog posts, other research recommendations. I took pictures of certain data analysis on my screen and ask it to poke holes in the trends or recreate X, Y, or Z.
That's interesting.
Ask it to build discounted cash flow models for me. And this thing is very much day one, a 25-year-old master's student in data analytics and like financial analysis. Very much. Now that sounds good, but on both sides of the coin, it also makes all the same mistakes that your green, fresh out of college person is going to make. I'm going to give you a couple of examples there. I threw a 10K at it, ask it to build a discounted cash flow model for me. It did it in about 25 seconds. It knocked my socks off. I was blown away. And then I realized it pulled the wrong free cash flow numbers and all of its analysis was wrong. But once I caught that, I could send it to a picture of the right free cash flow numbers and it would do that. So this company had free cash flow for the last 3 years of 111 million in 2021, negative 44 million in 2022, and 66 million in 2023. Again, just like a brand new hire, what did it do? When it got the right free cash flow numbers, it said, oh, my 5-year prediction for free cash flow is like 68, 71, 74, whatever, like a fairly linear model off the last number. When anyone with a brain looking at this goes, no, there's more turbulence than that. So then you have to coach it. You have to guide it. You have to say like, no, the future doesn't look like that. Make the 2027 free cash flow estimate X, but then it does all the math for you. It's kind of incredible.
I love what you did. I love the testing too. I'm excited to do a little bit myself. I don't know if I'll go that far this weekend, but what you made me think about is this. This is Doogles' statement to y'all. So take it or leave it. Yeah. Don't use these AI tools to do something that you don't know how to do. Use it to speed up things that you do know how to do, because then you can check the work. You can then coach it. All the stuff you're mentioning, just like I love the analogy you made with a new hire. It's the same way. If you have no idea how to do a cash flow statement, let's just say that, don't go hire a 25-year-old that has never done one before, but has like a outline for it to do it. You need to hire someone that knows how to do it if you have that. That's the situation. Same here. I love it because you got to coach it. You got to prompt it. You also have to encourage it. Like you have to be like, you're good. You are such a good financial. Like it is so much.
We're going
like
to talk about that in a second.
Okay, go.
So,
go.
No, I think you're exactly right. And that was my big takeaway. I feel like if you're an expert in the field or you're someone who is manager, executive level, whatever in a field, this adds so much power to you because you can pretty quickly catch the errors, correct the errors, coach it. And like, it doesn't formally have memory. I don't feel like the coaching I do, if that's the right term, is going to pay dividends for me like 6 weeks from now. But in the future, it's going to, right? A year down the road, I'm going to like be able to tailor and coach and always tell it to not make stupid linear assumptions with the way it does its discounted cash flows. And I think it will do that. It's pretty incredible. So here's another thing I did. I had a company come to me this week. They want to know how much rent they can pay because they're trying to buy a building. So I pulled up their industry. I pulled like 70 companies. I mean, I would need a research team to do this. And I started looking at PP&E expenses and lease expenses and all these other things, building this huge data set. Doogles, I was blown away. In about 15 minutes, I had this massive data set of 70 companies, and it went through all the 10Ks and pulled all this information. And I plotted it out. I'm like sending it back to the client with these hugely meaningful insights. I put it on a chart, and the chart doesn't make any sense. It doesn't have the conclusion that I know is right based on what the financials should say. So I start asking the thing, like, where you get these numbers? And it goes, oh, those numbers were hard to find. So I randomly generated 70 numbers for PP&E because I thought it'd be a fun data experiment. The stupid, like, this is where the employee goes on a pip, right? The stupid brand new employee forgot to tell their boss that they randomly generated numbers that their boss was going to make business critical conclusions off of. Like, it does stuff like that is infuriating and needs to be fixed. But again, because I kind of know what I'm doing here, like I caught it before I made ill conclusions. I catch that. I go, no, we can't do that. Like, that's okay. This is infuriating, right? So I say, like, go pull the 10K for company X, go find these numbers and do that. And it like does one, and it probably takes 5 minutes. And then it says, here's the result. I'm going to do the next one. And so I said, go away and do this for like 5 hours and come back and pull all the reports for me. It won't do it. And I think that's a cost of compute thing. But you literally have to
Like
sit
it
there and
refused.
babysit the thing and be like, good job finding the PP&E expenses for this. Now go find it for Nike. Infuriating and completely wrong. But again, you kind of see the promise.
I wonder if you were paying for an enterprise level versus the $20 a month, if that would work. I'm curious.
Well, absolutely, because if I'm paying for an enterprise level, I pay for all the compute I use, so
Yeah.
they don't care if I have the
Yeah.
thing running 24/7.
Can I tell
Here's
a brief
Yeah.
aside story,
Yeah.
which we love to do here? You just made me think about this. So making up randomly generated numbers. Back in the day, I'm not going to mention names here, but back in the day, I worked for a certain organization, and we were hired by another certain organization to do some work. The work was generally, it was like some of it was, should you buy this other company? Typical strategy stuff. But at one point, the person who was our client in the organization, he says, there's a presentation I have coming up, and a thing I need y'all to do is tell me what the stock returns will be for our competitors 10 years into the future. And we said, if we knew what the stock returns would be for your competitors, like we would just leave and go spend our money just doing that. Like we can't do that. And he said, but I need this for the presentation. And we said, what we would do is make up numbers. You understand? He said, what I'm telling you is that I need these numbers for the presentation. Will you please go and calculate these numbers? Effectively, the implicit request was make up numbers.
But in the ChatGPT world, that whole exercise takes you 15 minutes, and you let ChatGPT make up the horrible discounted cash flow estimates. And then you say, we ran a sophisticated discounted cash flow model, and we know the exact returns. It's perfect.
There you go. Made
the
up
fee
or
is
not.
$100,000 for that, by the way.
Yes, it's brilliant.
Yeah, I don't want to get on my high horse too much, but the other thing that I found is Google's almost dead for me. It's not officially dead. This update does real-time browsing of the web, which none of the previous models did. And it's funny because it consults their friend Bing. So I'm always like, oh no, ChatGPT went out to look at Bing. Can I trust these results? Right. But incredible stuff like, name a local manufacturer of X nearly instantaneously. The voice back and forth is great. I've heard that the voice coaching for language teaching is great, which I hope to take advantage of this summer. The ability to take pictures of things. I found a picture. I could not figure out where it was. I just said, look at this picture and tell me the location. It does it in seconds. It's really impressive. To me, this is at the point where the $20 a month is a no-brainer. Like that is part of my budget going forward. With the desktop app, it's great. You can also do things like throw a 10K at it of a company you're not familiar with and say, like, what's wrong with this? And it will go, well, it looks like it has really high debt levels because of poor acquisitions. And then you immediately dig to that section of the 10K and go, I'm pretty impressed. But your point is so critical. You have to be an expert in the field for it to add value. Otherwise, you're not going to catch the errors when it spits out the errors.
I love that you did all this work. I love it. It's cool getting into it. I'll let you know how some of my testing goes too.
Please do that. Let's do a follow-up next week on it.
Okay. All right. I'm reaching to the fishbowl. I want to talk about taxes. Specifically, there's this op-ed in the New York Times, and the opinion of the person that wrote this is, we need to tax us some billionaires. The general premise of this has been talked about so many times, right? Taxing wealth, people can get away with wealth. So I'm going to skip some of that general premise. What struck me, though, and you're probably going to say, yeah, everyone's known this for so long. But what struck me is it has a few graphs in here that have shown the difference in effective tax rates that I intellectually knew, but hadn't looked at in this form before. And so I thought it was quite interesting. I'm going to go through 3 of the graphs. The first is, if you look at the 400 richest Americans, this is all US. If you look at what I'm talking about here, if you look at the 400 richest Americans and look at their effective tax rate going from 1960 to 2018. In 1960, the effective tax rate was 56%. 2018, 23%. That is Dramatic. I'm talking Draymond Green-matic. The the next same chart, but the next chart is an overlay. So you take that 56 to 23 and all the years in between, and what it did, it showed, if you look at the bottom half of income earners in the US, their effective tax rate. And that is stayed kind of the same. It's like ended up around the same number, but it's gone from 22% to somewhere close to 30% around the year 2000. And then it's come back down, is now around 24%. So over that period, it's gone from 22% to 24%. So in the same general range. But if you look at the last two numbers, which is the story that everyone, like the headline, is that the bottom half of income earners in the US are paying a higher effective tax rate than the 400 richest people in the US. That is the headline that this op-ed. It also looks at, I'm not going to talk about these, but it does look at a few other countries like the Netherlands, Italy, et cetera, to show that this isn't just a US problem. But the last thing that I'll say is also for corporations. If you go from 1960 to 2018, corporations in 1960 paid a 52% tax rate, and it's a 21% tax rate in 2018. And one of the reasons that's important is if you combine those two things, part of the reason that the effective tax rate of the 400 richest Americans is what it is because they hold their money in, I'll call it stock, just to be in assets, but I'm just going to stock because it's easy to understand. So if you hold it in stock and your company's also paying less tax, then you can compound the value of the company, assuming that everything else is going well, right? And you're making money. You can compound the value of the company, which then compounds your own money, which you don't have to pay taxes on. That's like the short version of what's in the op-ed.
One hold up.
Okay.
One hold up is you have to pay taxes on it eventually.
Well, it
when
depends.
the capital gain occurs.
If the capital gain occurs.
Well, if the capital gain doesn't appear, it's not actually wealth.
Well,
it's paper wealth that you can't spend.
No. So here's the thing. Part of what folks do is they take out loans against their wealth.
Do.
Yeah, which is not taxed in the same way. And when you came off of a world that we were just in with 0% interest rates, like that was a fascinating time to be able to do that for some wealthy folks. So I agree. And I'm preaching the op-ed right now. I don't know how much I believe what I'm saying, but I'm just preaching what's on the op-ed. And it was saying that there are these companies with the ultra rich are also generally not high dividend. They might be zero dividend companies. So if they paid themselves dividends, they would have to pay taxes on that, but they do not. And even the capital gains tax is half of the tax rate.
Yeah, and let's just correct some of your garbage here. All right, so we're going to talk a real live example. In 2009, Jeff Bezos was Amazon's chief executive, and his salary was $81,000.
That's right.
Okay. Why is his salary $81,000? Because he doesn't want to pay tax on a $10 million salary, which is why Bezos, in so many ways, is smarter than like 90% of all the other CEOs out there. Even when he left, was smart, like very smart guy. Comes up, for those who don't know, comes up from D.E. Shaw, an investing shop, like very, very smart financial guy. But he owned 10% of the company, which made a profit of $30 billion in 2023. Of course, Bezos, in a zero interest rate environment, takes out, if he needs money, which he probably doesn't, but he takes out debt against the shares that he owns, which are worth billions of dollars. So he doesn't have to trigger the capital gain and pay that tax, because when people are offering you debt at zero interest rates, the interest charge of that debt is going to be tax deductible. Like, it's just smarter.
Yeah.
That I understand why people write these articles, and I don't necessarily have a problem with these articles, but where we should put all our hate, not all our hate, a significant amount of our hate is at the people that write the tax codes that are so stupid. This is idiotic. And then you have some of the wealthiest and smartest people, or maybe they're the wealthiest and dumbest people, but they can hire smart people to find loopholes. Like, the problem is the tax code here. The problem is not the 400 richest Americans.
Absolutely. And this is what, not just Buffett, but this is what Buffett has said a lot, and Buffett and others have said a lot. They've said, I have no problem paying taxes. However, I'm going to follow the code and make the amount of money that I can make according to what the tax code is. But change that and I will pay taxes. Like I don't have an issue with paying taxes.
And so where this chart is striking to me, the one that goes from 56% to 23%, a lot of times none of this is that hard. The trend here is not sustainable. You can see how it compares to our national deficit and everything else. But also a long set of data, 50 plus years worth of data, is really powerful. You probably know that the effective tax rate for these 400 people should not be 56%, an outlier. You probably also know it should not be 23%, an outlier. Find a way to make it 40%, which is the historical average. Call it a day. Simplify the tax code.
It's hard to take advantage of something that's simple.
Exactly.
That's the point. That's the point you're missing. Oh, okay. That's the point you're making. Okay.
At tax time, we talked about the billions of dollars that are wasted in tax prep and tax preparation expenses that no one sees as additive to the economy, maybe with the exception of a few CPAs. It's just stupid. We need to fix it. It's not going to get fixed because our government is dysfunctional.
0%. And there was, for those people that are subscribed to the Substack, skippydoogles.substack.com. Please do it. It's worthwhile. You get all the notes from our show and other treats. But for those of you that aren't, last week's Substack, in the hot takes section, there's an article called "Simplicity is an Advantage, but sadly complexity sells better."
Yes.
That's worth reading.
Well, let's go back to the investment profession. No one knocks on your door and says, you know what? There's this Vanguard index fund, incredible returns, and the fee is 4 basis points. This will make you wealthy. You know the reason no one knocks on your door? Because there's no commission on that. There's no middleman there. There's no one to speak up and scream from the rooftops that this is good for you. This happens in the grocery store with fruit and vegetables. There's no margin to be made on fruit and vegetables. So no one actually sells it. No one puts it in a bright pink box to sell it to your kids. And therefore, we buy the stuff where there's margin. It goes back to the listener mail in a way. It's just the flashy stuff is flashy for a reason, and it's flashy because someone can get rich off of you.
It's sad.
It's sad. I want to talk briefly, although I'm not going to do a deep dive on this, but I will send an article your way about Red Lobster.
Oh, okay. Now you're talking.
Red Lobster is pretty much going bankrupt. Well, they will file for bankruptcy. It's basically a done deal. The fun, like Instagram level talking points on this is they did unlimited all you can eat crab and all you can eat shrimp, and it like bankrupted them. It's not actually what happened, right?
I mean, yes, continue.
It's fun to say that though. Like those are, if I'm in a presidential debate and someone brings up Red Lobster, like the zinger is like, oh, I shouldn't have done the all you can eat shrimp, and then debate's over. Even though that's like such.
Can we pretend like that is the story for a second? What I love about that is I hear that and I go, what were the other ideas? Like if that's what you chose, what else was on the table? Like, oh, give us the real deal.
No, I mean, I'll even talk about it at a high level. We're not going to do a deep dive on Red Lobster. No one cares. But it's basically been stagnant since 2014, right? It used to be owned by Darden Restaurants, which owns Olive Garden and a bunch of other stuff.
Solid company.
They divested because they were like, what are we doing with Red Lobster? Like it's kind of stagnant. They're not opening new stores. They're not really doing this. But here's what I think happened behind the scenes, Doogles. And I just wish people could see it. Of course, they sell to private equity. The private equity company does sale leasebacks on the property because this is kind of like Kohl's, where Red Lobster owned a bunch of their property. So they're like, oh, we're going to get creative. You're going to do financial shenanigans to be like, this is a great purchase, right? And then they take the value of that property, which is clearly tied to the financial health of Red Lobster, because that's who pays the rent on that property. Yep. And you like free up some cash in the short term. Well, that brings all the rents up to market levels, it seems, which before, because they own the property, they were probably saving money on rent, which is why someone like Red Lobster. I mean, think of your local restaurant that's been around for 50 years. It's maybe run by the family that everyone goes, there's no one in there. I don't know how they operate. It's
I have so many
probably
of those.
because,
I have
but
so
it's
many of those.
probably
Yeah.
because they own the space.
Yeah.
Like there was a study done in New York City of the restaurants that stayed around, and someone tried to figure out like why certain restaurants had staying power. And this is like corner pizza places. And what they concluded was the people that bought the property in 1975 are still around. And everyone else that pays market level rent turns over frequently. I'm being dramatic with that conclusion, but effectively, that was a huge deal in their operating costs, which made it so you could operate with the like lower gross sales and get the same margin. It's obvious.
Yep.
I think the real story behind Red Lobster, I'll just cut to the chase, is effectively that they used to have this huge competitive advantage because they had purchased real estate at deal prices many, many years ago. They no longer have that competitive advantage, and now they're bankrupt. But I don't think that talking point is nearly as sexy as they had all you can eat shrimp and they're done.
Similar, but different in a very important way to part of the Southwest story. Because you have Southwest Airlines back in the 1970s bought a lot of oil futures. So they were able to maintain low oil prices until I think for about 30 years. I think it was about 15, 20-ish years ago when those started to fade out. The difference is Southwest also ran a tight operation. So they had like a double advantage, basically. They had these low prices and they ran a tight ship. And so operating wise, they were great. And they had this advantage. When you don't understand that advantage, it's like the investors in 2020, when you don't understand that the advantage is a bonus and not the core of your operation, then you won't be as diligent with the rest of how you operate, which is probably what happened with them. And so when they then lost that advantage,
then you go bankrupt. That's what happens.
Yeah.
And they're on their second private equity firm, which is effectively saying like, we don't want to invest in Red Lobster anymore. That's effectively what it comes down to. It's not like
it's extraction. Value extraction is what's happening at that point.
Yes. And which would not be the case if it was still run by the original family, or probably even still run in the Darden family. Like, I don't know. I'm kind of obsessed / fascinated with companies that think, we talked about this last week, think really long term and try and make smart bets about weathering storms. And the second private equity shows up at your door, that mindset is no longer the case. And then you're more likely to go bankrupt when rough times hit. That's just how it works.
True story.
All right, Doogles. Anything else in your fishbowl?
Nah.
It's felt good to get this off my chest, to give you a hard time about Pool Corporation. This is really fun.
What I want to find out is that you are the largest short of Pool Corporation. That would just be. Can you make part of your 0.2% of your portfolio? Can it be a short of Pool? And then we will just have a full battle.
Unlimited risk of loss is not part of my investing thesis.
I hear you.
Cool. Hit skippydoogles.com for all things related to the show. The Substack's really good. Doogles, I'm seeing, this shocked me, so this is more banter than anything else. Right now, we're getting more downloads from Spotify than we are from Apple Podcasts.
It's an interesting switch.
Times are changing. So hit us with a review on Spotify, please. Help other people find the show. We'll talk to you next week.
Bye.